Sebastian.org. The Sebastian Gorka would say. Alright, we're almost done here.
Okay.
I'm gonna take all of my stuff,
Got it.
run out the door, put the phone on charge in the car, and call my lovely. And the greatest wife in the world.
It's always nice to have.
We have a story about that, how we met.
Mm-hmm.
We met at, I was a widower.
Mm.
My late wife was a best friend. She's our accountant now.
Mm.
But she had a birthday party, last one she ever had in 2012.
Wow.
And she asked me if I'd come over and help her celebrate her birthday. Well, hell yes, I will.
Mm.
She had a nephew, birthday 2 days different.
Wow.
She said, why don't you find a really nice girl and bring her? Well, he brought her. I walked away with her.
Man.
Can't knock that.
Yeah, that's true.
So anyway, you pretty much know what to do. Oh, I need to turn this around for a moment so that I
Okay.
can get the levels turned up a little more.
Yeah, no worries. No worries at all. Yeah. Do what you gotta do. About to start this
I'll
show.
turn it back when I'm done.
Yeah, no worries. All right, thank you all for tuning in to WGAT 98.3, WGAT LP FM 98.3. My name is Jeff Badu, and I'm a certified public accountant as well as a parallel entrepreneur. I'm the founder and CEO of Badu Enterprises LLC, which is a multinational conglomerate in the finance industry. So sorry for the late start today, but we won't be that long today. Happy MLK Day for those out there listening live. So today, we're just gonna jump right into the tax plan that's actually essentially proposed. So everything that I say today is proposed. There's nothing that's actual law yet, but it will most likely be law due to the status of the government. And there is basically there's an inauguration coming up of our new president. And today, really here to just talk about the tax plan. What are some things in the tax code to look into in the future? We won't be that long today. We'll probably be about 20 to 30 minutes max, because I know today is a holiday, and also taxes in general aren't the sexiest topic in the world. I always say that. We try to make it fun. We try to make it entertaining. But at the same time, I understand that the topic of taxes isn't always the best. So let's jump right into it. We won't do a market report today because the report is actually delayed until tomorrow. And once again, sorry for the late start. And thank you all for tuning in to WGAT LP 98.3 FM. So let's just jump right into it. So we're talking about essentially a few things under the Biden tax plan. So today's topic is officially the Biden tax plan. And there's talks about President-elect Biden, according to the tax plan he released before the election, would enact a number of policies that would raise taxes on individuals with income above $400,000. So essentially, the main people that will be impacted, or the main people targeted with this tax plan, are those who are earning over $400,000, usually W-2 income. So immediately, what does that let me know? I should not have a W-2 income, right? Because anytime they come out with something that says, if you fall in this category, then something bad, right? And I don't think anybody listening today wants to pay more taxes than they truly should. So with that being said, we have to be very, very smart about some of the decisions that we do make as it relates to taxes. Of course, I'm a CPA. I help a lot of clients with their taxes. We have a team of about 30 people right now in our tax firm that assists clients as well. And I know nobody on this channel today or listening today wants to pay taxes more than they truly should. So off the bat, it lets me know stay away from W-2 income as much as possible. And then if you're a business owner that has a sole proprietorship, unincorporated, and you're still using a Schedule C, you might want to think about changing that to making it perhaps maybe an S corporation or even a C corporation. So here's a few things. It includes raising individual income, capital gains, and payroll taxes. All three. They're hitting you 3 times on the taxes. Biden would also raise taxes on corporations, mainly C corporations, by raising the corporate income tax rate and imposing a corporate minimum book tax. Biden's plan would raise tax revenue by $3.3 trillion over the next decade on a conventional basis. Ironically, the U.S. government is in $3 trillion, and it's probably going to be in another $7 trillion, probably by the end of either this year or next year. So $10 trillion total. With all the stimulus, all the COVID-19, all the stuff that's been happening, I believe we'll be in some pretty serious, even more serious debt. I mean, we're already in serious debt right now, but we'll be in even more serious debt. For those joining, welcome to WJT LP 98.3 FM. Essentially where change happens, and also it's your voice, your music, and your station. My name is Chef Badu, and today we're talking about the Biden tax plan. Real simple. Just getting into the nuts and bolts of it, and just sharing some of the details about the plan. Nothing that I say today is actually in effect or in law right now, but it most likely will be. So just something to keep in mind, and that everything I say today is proposed, meaning there may be changes, there may be adjustments, but this will most likely be the law by the end of this year, effective next year, 2022. And welcome to 2021 for those that made it. So I mentioned that it would raise tax revenue by $3.3 trillion. And then also, it would lower the originally estimated, basically it would lower the original estimate due to revenue effects of the coronavirus or the COVID-19 pandemic and economic downturn, as well as new tax credits. So now let's continue the discussion here. So here's a few highlights, a few things that you should get to know. And I'll share this in a bit more details later on. The first thing is it would repeal the Tax Cuts and Jobs Act components for high-income filers. It would impose a 12.4% Social Security payroll tax for wages above $400,000. Right, so right now there's a cap, and basically this would unleash the cap or release the cap so that it can go into the Wild Wild West territory. It would increase the corporate income tax rate to 28%, establish a corporate minimum tax on book income, double the tax rate on GILTI, and impose it country by country, temporarily increase the generosity of the child tax credit and the dependent credit. So let's get into a few of the nuts and bolts of the details. And remember, you don't have to be a tax professional to basically not necessarily understand this, but make sure that it's relevant, because this is stuff that will impact us over the next 4 years at least. So it is very important to pay attention to this information. It's not the sexiest thing. I'm not even going to lie. It's not the sexiest information, but I guarantee you, if you listen today, it will help you plan for the future. It will help you make better decisions moving forward, especially if you plan to be in that 400,000 plus income range. So basically today, I really want to summarize, just give you a summary of the things Some of it will be detailed, so you may not necessarily need these details, but it's always better, it's always safer to get into the details as opposed to giving mere summaries. So let's see a few things here. The first thing is it would impose a 12.4% old age survivors and disability insurance, or Social Security for short, FICA for short, payroll tax on income earned above $400,000, evenly split between employers and employees. So not only would the employees get to pay for it, but also the employers would pay for it. This would create a donut hole in the current Social Security payroll tax, where wages between $137,700 and the current wage cap and $400,000 are not taxed. At least they don't incur a Social Security tax, or a payroll tax for short. So that's the first one. It would increase Social Security taxes for those earning above $400,000. Remember, advice: stay away from W-2 income if you can. My doctors, my lawyers, I feel for you. You know, it's quite depressing to see somebody go through something like that. You're talking about a 12.4% tax. And we're not talking about income taxes. We're just talking about Social Security taxes. Some of you may have heard that tax rates may go up to as high as 63% if you live in California, New York. Well, it's actually true. And by the way, right now, it is pretty high. It's basically 50% right now. So that's just something to keep in mind there. Another thing that goes along with this plan is it would revert the top individual income tax rate for taxable incomes above $400,000. So Biden is really planning to hit those that make $400,000 or more, from 37% under the current law to the pre-Tax Cuts and Jobs Act, aka the Obama administration, of 39.6%. So the highest tax rate would be 39.6%. Taxes, this is huge. Taxes on long-term capital gains and qualified dividends for my C corporations out there at the ordinary income tax rate of 39.6% on income above $1 million, and eliminate step-up basis for capital gains taxation. I mean, that is ugly. If you're the one that has sold something that is appreciated in value and you sell it, let's say you make above $1 million, or your total income for the year is above $1 million, well, now you have to pay the higher 40% ordinary income tax rate as opposed to the favorable long-term capital gains tax rate, currently high as 20%. So it would double your taxes basically. And then there's a thing called step-up basis, which I won't get into the details of it. But basically, if somebody passes away and an asset is, let's say a house is passed to somebody else, they can get it tax-free. Now they don't get it tax-free. They get it at whatever the person who passed away bought it at, and then they have to pay taxes on the difference between the two. I mean, that is ugly. I think that is highway robbery, to say the least. It caps the tax benefit of itemized deductions to 28% of value for those earning more than $400,000. Once again, this $400,000 number just keeps popping up, which means that taxpayers earning above that income threshold with tax rates higher than 28% would face limited itemized deductions, as if they weren't already limited. It would restore the PEACE limitation on itemized deductions for taxable incomes above $400,000. Once again, that number. It phases out the qualified business income deduction, or QBI for short, or in other words, Section 199A, for filers with taxable income above $400,000. It expands the Earned Income Tax Credit, or EITC for short, for childless workers aged 65 plus. Provides renewable energy related tax credits to individuals. So one of the things that the government wants us to do is be more efficient, use more sort of renewable energy sources. It doesn't want to basically destroy the planet, so it incentivizes people to do certain things. So if you are looking to buy a house, or if you're into investments, you might want to think about using renewable, more efficient energy sources in your home because you can get a tax credit for that. One thing about the government is they will incentivize you to do certain things that I think you should do anyway, and that's going to help cut your tax liability down. And that's what the wealthy folks do. They find the loopholes in the system, they use it to their advantage, and they're ultimately helping the economy. It expands the Child and Dependent Care Tax Credit, CDCTC for short, from a maximum of $3,000, which was, that was pretty bad, and qualified expenses to $8,000, and then $16,000 for multiple dependents, and increases the maximum reimbursement rate from 35% to 50%. Basically, you get a $4,000 per child or dependent credit, which is huge. I mean, under the current law, it sucks, to be honest. It really, really does suck. So now you get 50% up to $8,000. So that's some good there, right? To every negative, there is some positive in there. For 2021, and as long as economic conditions require, increases the child tax credit. So this is 2021. This is a retroactive one. It increases the child tax credit from a maximum value of $2,000 to $3,000 for children age 17 or younger, while providing a $600 bonus credit, so additional credit for children under 6. I think that's good. I've always felt like the tax code cheated those who had kids, especially the working parents out there. And I think this is some good right here. I think this is huge. The CTC, or Child Tax Credit for short, would also be made fully refundable, removing the $2,500 reimbursement threshold and the 15% phase-in rate. So it'll be fully refundable. So that's pretty nice. I think that's pretty nice. It would reestablish, I smell recession. I smell 2008. Reestablishes the first-time homebuyers tax credit, which was originally created during the Great Recession, to help the housing market. Biden's homebuyers credit would provide up to $15,000 for first-time homebuyers. If you don't own a home, this is huge right here. Not saying wait to buy the home. I don't think anybody should wait. If you have a home that you're ready to buy, go buy it right now. But if you want to wait a little bit, maybe to 2022, then you could get a first-time homebuyers credit if you qualify, up to $15,000. So that's pretty nice. And then it expands the estate and gift tax by restoring the rate and exemption to 2009 levels. For the purposes of this segment today, I won't even cover what that means. Let's just say that's some pretty bad news if you're either wealthy or ultra wealthy, especially for those who are ultra wealthy. But as one law is created, so is the loophole. So always remember, the wealthy don't really get impacted. They will get impacted by this. They just have to change their strategies a bit. So one way to overcome a lot of this stuff is you set up trusts. You set up basically what's called tax shelters, asset protection vehicles. There's so many things out there that are still within the code. And guess what? You can take action now to grandfather or lock in some of your strategies so that you don't have to get impacted by this Biden tax plan. Because remember, I don't think there's anybody that's listening to this segment right now that wants to pay more taxes than they truly should. So this is stuff that is very important to pay attention to. Moving on, it increases the corporate income tax rate from 21% to 28%. So the goal is to tax more corporations. You might have heard Amazon didn't pay any income taxes in 2018. So these are some of the things that you should keep in mind. It creates a minimum tax on corporations with book profits of $100 million or more. The minimum tax is structured as an alternative minimum tax. Corporations will pay the greater of the regular corporate income tax or the 15% minimum tax, while still allowing for net operating loss, NOLs, and foreign tax credits. That's a big one right there. It doubles the tax rate on global intangible low tax income, GILTI for short, earned by foreign subsidiaries of U.S. firms from 10.5% to 21%. Basically, it's incentivizing people to stay local. To stay national, to stay in the U.S., not go overseas. Remember, these companies, they have some of the smartest accountants, some of the smartest attorneys. They'll figure out a way to not pay taxes. This is just them creating more complexities for themselves that just leads to more and more money being paid to the IRS, more and more money being paid to auditors, and essentially it might not achieve the goal that they think it will achieve. I think that there are some good out of this tax plan, but I really think they need to reevaluate some of the things that they're doing within this. In addition to doubling the tax rate on the GILTI, Biden proposes to assess GILTI, GILTI for short, on a country-by-country basis and eliminate GILTI's exemption for deemed returns under 10% for qualified business asset investment, QBAI. Nobody probably knows what I just said, so let me just skip that one. Establishes a manufacturing communities tax credit to reduce the tax liability of businesses that experience workforce layoffs or a major government institute closure. And oh, by the way, there is a stimulus package 3 coming out probably within the next month or two. So please get ready. PPP 3, EIDL 3, potentially. Stimulus checks, $1,400 checks. Get ready. If you don't have your taxes done for 2019, please get them done as soon as possible. If you haven't started 2020, getting your record keeping and everything in order, get it done. Be the first in line and the first to get paid. It expands the new markets tax credit and makes it permanent. We got about 5 more minutes, by the way. Offers tax credits to small business for adopting workplace retirement savings plans. Hint, hint, tax loophole. Expands several renewable energy-related tax credits, including tax credits for carbon capture use and storage, as well as credits for residential energy efficiency, and a restoration of the Energy Investment Tax Credit, ITC for short, and the Electric Vehicle Tax Credit. My, oh my, Tesla. Your stock price is probably going to go up over the next 4 years because more people will want to buy Teslas. Because the old, they still do have the credit and it's phased out over time. But man, to basically restore that credit, that's huge. And the Biden plan would also end tax subsidies for fossil fuels. A few things that just aren't big enough, but just good to know. Imposes a new 10% surtax on corporations that offshore manufacturing. So if you make stuff in China, and service jobs to foreign nations in order to sell goods or products or provide services back to the American market. Sounds a bit like Apple. This surtax would raise the effective corporate tax rate on this activity up to 30.8%. Right, that's huge. That's big right there. Basically, they want people to essentially have, they ultimately want people to hire people that's in the U.S. They want to buy in the U.S. and they want to spend in the U.S. And shout out to Chief of Gains. That's on Instagram right now. And shout out to Abeg Train Me as well. So with that, we have the 30.8% tax that would basically increase for somebody who's making stuff overseas, bringing it back to the U.S., selling it to U.S. customers. Remember, these companies are smart. They'll find ways to go around it, no matter what. It establishes an advanceable 10% Made in America tax credit. I like this one. For activities that restore production, revitalize existing closing facilities, retool facilities to advance manufacturing employment, or expand manufacturing payroll. So the Amazons of the world, these might be avenues. Right, they might just say, okay, do everything in America. So what? Pay people what they deserve, $15 an hour or whatever it is at that time, and get your credits, get your tax credits. That's how Amazon was able to not pay any income taxes. By the way, they just found stuff in the code. They say, oh yeah, we'll do this. We'll hire ex-felons. We'll do all this, and boom, got tax credits for all that stuff. So that's pretty much what's going to happen. Is the wealthy will figure it out, right? And I hope that if you're not wealthy today, you step into that category or you step into that world, sooner than later. Because it does create a whole new world of opportunities for you, especially if you own things like real estate and a business. If you own those two combined, you'll probably not pay any income taxes for the rest of your life. So just understand that to every law, there's a loophole. To every strategy or to everything that's meant to attack somebody, there's always a defense mechanism, and aka tax credits, aka loopholes. And this stuff is important. Remember, it's very important. Taxes can drain about 40% on average of somebody's budget. And so please always pay attention to that line item on your budget. Moving on, we got about just a few more minutes. It's about 2 more minutes here, 2-minute warning. It equalizes the tax benefits for traditional retirement accounts, such as 401ks and individual retirement accounts, by providing a refundable tax credit in place of traditional deductibility. So you won't be able to deduct traditional IRAs and 401ks anymore on your tax returns or on your pay stubs. This is huge. A lot of Americans, a lot of people, and I love this one because a lot of people were saving incorrectly for retirement anyway. So I think this sort of reshifts the focus of retirement to doing more after-tax accounts as opposed to pre-tax. And now you get a tax credit for it as well. That's beautiful. So if you're already doing Roth IRA, Roth 401k, you're double dipping now. It eliminates certain real estate industry tax provisions. And I hate this one, the fact that they're getting rid of it. But 1031 exchanges, where you can trade one property for another. I personally don't understand why they would get rid of such a thing. And then it also sort of limits or restricts opportunity zones, which I don't really understand that either. Opportunity zones is an opportunity for you to sell something at a gain, reinvest the gain, and significantly improve a neighborhood, basically. I mean, why would they want to change that? Doesn't make any sense. And then also, just a few more things here. Remember, not to get political. I'm not into politics at all. Democrats, Republicans, I can really care less personally. What I care about is what's the rules, where's the stimulus, tell me how I got to get it, tell me how my clients can get it, and that's it. And it also expands the Affordable Care Act's premium tax credit. So if you receive health insurance through the government, then it expands your credit. It creates a refundable renter's tax credit. I don't understand the purpose of this either. I feel like they're just backwards with some of this stuff. It creates a refundable renter. So if you're a renter, it creates a tax credit for you, capped at $5 billion per year, aimed at holding rent and utility payments at 30% of monthly income. I guess maybe that can make sense. But that's just incentivizing people to rent as opposed to own. And when people own, they can pay more property taxes. And when they pay more property taxes, the counties and the cities and the states and all that, they get, they can now fund pensions and they can now fund roads and schools. So to incentivize people to rent doesn't really make any sense to me. You should be incentivizing people to own a home as opposed to rent. Right? So these are all, and of course these are all my own personal opinions, right? You do not have to agree with them. I just use common sense, logical statements when it comes to some of these things. Last but not least, it increases the generosity of the low-income housing tax credit. I like that one because all of our apartments are pretty much in low-income neighborhoods. And so to be able to expand or increase the tax credit on that, I mean, that's just great news for us. We'll continuously invest in low-income neighborhoods. We have all of our buildings are really on the south side of Chicago. And neighborhoods such as Auburn Gresham, Chatham, Woodlawn, there's a few more out South Shore. There's a few more out there. So ultimately, these are things you have to think about, right? There's stimulus money coming. There's already stimulus. There's a first stimulus package, second stimulus package, which we're working through. If you do need help with PPP loan and EIDL and all these stimulus applications, please feel free to reach out. Our number is 773-679-7198. Once again, 773-679-7198. Check out the website, jeffbadu.com, to inquire about more information. We're always here to help. There's a third stimulus package coming in a month or two, right? About $2 trillion, 1.9 to be exact. $2 trillion to add more debt to the U.S., right? They just keep printing money. There's probably somebody in the back office right now at the Fed printing money. It's crazy, which devalues the U.S. dollar, causes taxes to go up because somebody's got to pay for it. And now they're targeting the people making $400,000 or more, aka doctors and lawyers, and other high-paid professionals. So if you're not a business owner, try to find a way to be a business owner, an entrepreneur. If you're not a real estate investor, try to find a way to be a real estate investor. That's the key there. And just a few comments here. Trying to increase rental infrastructure development. Yeah, that could be it. That could be it right there. And we got comments. Inglewood. Yeah, we invest in Inglewood too. Inglewood probably got a few more years. I think it is quite the wild, wild west out there, but that is a neighborhood that we are working to revitalize as well. Remember, we don't use the term gentrified. I don't really like that term too much, but I say revitalize, improve, right? Especially if the people that live there, or basically the people that are investing, look just like the people that live there. Right? I think revitalize is a better term to use. So what you can do, trade that W-2 for a 1099 or a business. If you don't own real estate, start owning some real estate and go out and get some stimulus money. I mean, they're just throwing it out there. $900 billion in the second round, right? $2 trillion in the first round, and now another $2 trillion coming in the third round. And I think there will be a fourth and a fifth round to wrap out the year. So that's huge. That is huge. Absolutely. And yeah, I do love Inglewood. I love Inglewood as a neighborhood. It's not the safest neighborhood, of course. It's not the safest neighborhood in the world, but I like up-and-coming neighborhoods. I mean, I'm personally not afraid to get into those neighborhoods. Some people are scared because they're worried about crime. Yeah, crime is definitely a big thing, but, I mean, if you got the right people and you got the right connections and everything, you should be good, right? Make sure you protect your property with security systems, you know. Perhaps get somebody who's in the neighborhood to watch over the home. You should be good investing in those neighborhoods. Remember, it's not the safest, and you do have to proceed with caution. So it is something. We actually do own one property in Inglewood right now. It's a 4-unit building, and it's actually it's our only Section 8 building right now, and it's doing pretty good, you know. So Inglewood is somewhere you could potentially invest in. You do have to be careful, right? But I don't think it's impossible. I don't think it's impossible to invest in that. So we are out of time. I actually do have another workshop right after this. Happy MLK Day once again. Hope you all got to do something in honor of our dear Dr. King. You know, that I can go on and on and on about all the things that he did for us to get us to where we are today. Yeah, thank you, Chief of Gains. Luckily, Badu Tax Services has risk assessment for those looking at higher risk areas. Absolutely. All right. So with that being said, thank you all for tuning in to WJC LP FM 98.3. Your voice, your music, your station, and where change happens. My name is Chef Badu, and I look forward to continuously delivering you all some content. Thank you.